What if your investments could pay you? I mean, really pay you, like a regular paycheck, without you ever having to sell a single share? Well, today we're going to break down exactly how that works. So let's dive right into that question. This idea is really the whole point of something called income investing. It's all about turning your portfolio into a kind of cash flow machine, one that generates money you can actually use, just like income from a job. And the main tool investors use to make this happen is the Dividend ETF. So let's pull back the curtain and see what these things are all about. Okay, think of it this way. Instead of you going out and buying stock in just one company, a dividend ETF is like buying a whole basket full of them. But, and this is the key, they're not just any stocks. These are specifically from companies that have a habit of sharing their profits with people like you and me. I love this analogy. It's like owning an entire orchard of fruit trees. You get to collect the fruit, those are the dividends, without ever having to sell the trees themselves. Pretty cool, right? So this really gets to the DNA of a dividend ETF. You see the mix here, right? They're designed to give you that regular income by focusing on solid, established companies. But at the same time, you're not sitting on the sidelines. You still have exposure to the stock market and its potential for growth. It's that combo of income and relative stability that really makes them so popular. But here's the thing, it's not a one-size-fits-all deal. Nope. Dividend ETFs actually come in a few different flavors, and each one has its own unique strategy for picking which stocks go into that basket. So here are the four main approaches. First, you've got high dividend funds. These guys are chasing the biggest payouts, which sounds great, but it can come with higher risk. Then there's dividend growth, which focuses on companies that are consistently increasing their dividends year after year. That's often a sign of a really healthy business. The aristocrats are the absolute champions of that, and we'll talk more about them in a second. And finally, broad dividend funds give you a little bit of everything, a more balanced, diversified take. Yeah, that aristocrats group deserves its own moment. Just stop and think about that for a second. A company that has raised its dividend payout every single year for more than a quarter of a century. That's through recessions, market crashes, you name it. That signals an absolutely incredible level of stability and a serious commitment to rewarding shareholders. So, with all these different types in mind, why do so many investors choose to go down this road in the first place? What are the big draws? Well, the appeal is pretty clear, isn't it? You get that predictable cash flow coming in from dividends, but you're still in the game. Your shares can still grow in value over time. And that stability usually comes from investing in big, mature companies that have been around the block. Plus, because it's an ETF, you automatically get diversification. It's a really powerful combination of perks. But look, investing is always about trade-offs. It can't all be good news. So to get the full story, we have to flip the coin over and look at the potential pitfalls. This is super important to remember. Dividends are not guaranteed. If a company runs into trouble, one of the first things it might do is cut that payout. You also have to be really careful of yields that just seem too good to be true. Sometimes a sky-high yield is actually a warning sign that the company's stock price has tanked because it's in financial distress. And lastly, when the market is red hot and soaring, these more stable companies might not keep up with the high-flying growth stocks. And this all leads us to the fundamental choice every single investor has to make. So this is a question for you. Are you trying to generate spendable cash flow right now? Or is your main goal to maximize the total growth of your investment for the long haul? So how do you actually make that call for yourself? How do you know if this kind of strategy lines up with your own personal financial goals? At the end of the day, there is no single right answer for everyone. It all comes down to your personal situation, your timeline, and what you need your money to do for you. If you're getting close to retirement, that steady income might be absolutely crucial. But if you're just starting your career, maybe you're willing to skip that income for a shot at bigger growth down the road. And that leaves us with this final question to chew on. Going back to our orchard analogy, when you look at your own financial future, what's more important? Is it harvesting the fruit today on a regular basis? Or is it letting that tree grow as big and strong as it possibly can for the future? Your answer to that question will tell you almost everything you need to know about whether a dividend strategy is the right fit for you.